In 2008, the stock market lost more than half its value. Millions of retirees watched their life savings get cut in half almost overnight. Meet two retirees. Same age, same $1 million saved, both retired right before the exact same crash. One of them was wiped out. Within a few years the money was gone, and at 70 years old he had to go back to work. The other barely flinched. Her income never stopped, her lifestyle never changed, and her money outlived her. Same money. Same crash. Completely opposite endings. So what did she do that he did not? And here is the part that matters. She did not predict the crash, she did not pull out at the top, and she did not get lucky. She did a handful of specific, unglamorous things that smart retirees quietly do to make crashes almost irrelevant. Because here is the uncomfortable truth nobody tells you: you cannot avoid market crashes, but you can make them stop mattering. Let me show you how. First, let me be honest with you, because the title is a bit of a trick. No one, not even the smartest retiree alive, can dodge every market crash. Crashes are not rare accidents. Over a 30-year retirement you should expect to live through several of them. They are a feature of investing, not a glitch. So the goal is not to avoid them. The goal is to build your money so that when a crash comes, and it will, it does almost no damage to your actual life. A panicked retiree reacts to crashes. A smart retiree has already prepared for them long before they arrive. I am going to walk you through exactly what those smart retirees do, the same moves that let our second retiree sleep through a crash that destroyed the first. But to understand all of it, you first have to meet the single enemy every one of these moves is designed to beat. It has a boring name and a brutal effect. It is called sequence of returns risk, and it is the reason two people with the same money can have completely different outcomes. While you are still working and saving, a crash is almost a gift. You keep buying shares cheaply and you have years to recover. But in retirement the math flips. You are no longer adding money, you are pulling it out to live on. If a crash hits while you are selling shares to pay your bills, you are locking in losses and selling more shares at the worst possible price. And a crash in the first few years of retirement is the most dangerous of all. It can quietly doom a portfolio that looked perfectly healthy. This is the enemy. Every smart move that follows exists to make sure a crash never forces you to sell at the bottom. So here is the first thing smart retirees do, and it is beautifully simple. Move 1. They keep a cushion of 1 to 3 years of living expenses in cash and safe, stable accounts. Think of it as buckets. One bucket is cash for the next couple of years. Another is steadier investments. The last is long-term growth. When a crash hits, they do not touch their stocks. They calmly spend from the cash bucket and let the investments recover. This single move neutralizes sequence of returns risk, because they are never forced to sell shares while prices are down. In good years, they top the cash bucket back up from their gains. In bad years, they simply leave it alone and live off the cushion. A retiree with 2 years of cash can wait out almost any crash in history without selling a single share at a loss. The second move makes sure not everything falls at once. Move 2. They spread their money so that not everything crashes at the same time. Alongside stocks, they hold bonds, cash, and other steadier assets that often hold their value, or even rise, when stocks fall. The point of diversification is simple. When one part of your money is having a terrible year, another part is holding the floor. In many crashes, while stocks were plunging, the safer parts of a balanced portfolio barely moved, giving the retiree something stable to spend from. A diversified portfolio falls less, recovers faster, and is far easier to stay calm with, which matters more than people realize. No mix is crash-proof, and diversification does not mean zero losses. It means you are never fully exposed to a single disaster. The third move is about timing, but not the kind you think. Move 3. They gradually shift towards safer assets as they get closer to and into retirement. A 30-year-old can hold mostly stocks and ride out any crash, because they have decades to recover. A 70-year-old cannot. So smart investors slowly dial down their risk over time, holding less in stocks and more in stable assets as retirement approaches. The idea is to take the most risk when a crash barely matters, and the least risk when a crash could end your plan. They do not go to zero stocks. They simply make sure a crash can never take down the portion they actually need to live on soon. Your risk should fall as your need for the money rises. That single principle prevents a huge number of retirement disasters. The fourth move changes where their money even comes from. Move 4. Wherever possible, they live on the income their money produces, not by selling pieces of it. Dividends from stocks, interest from bonds, rent from property. This is money that arrives without selling a single share. When the market crashes, share prices fall, but solid companies often keep paying their dividends right through it. So an income-focused retiree keeps getting paid during a crash while their share count, and their recovery power, stays fully intact. Compare that to someone selling shares every month. In a crash, they have to sell more and more shares to get the same income, draining the account fast. Income is not guaranteed, dividends can be cut, so this still needs diversification. But living on income instead of sales is a powerful buffer. The fifth move builds a floor under everything. Move 5. They make sure their essential bills are covered by income that a crash cannot touch. Things like Social Security, a pension, or in some cases an annuity provide a baseline of income that keeps arriving no matter what the market does. The goal is to have the non-negotiables, housing, food, healthcare, covered by this guaranteed floor. Once the essentials are safe, the money in the market is for extras and growth, not survival. That completely changes how a crash feels. When a crash cannot threaten your basic life, you stop panicking, and you stop making the desperate moves that destroy portfolios. Each of these tools has trade-offs, especially annuities, so they are not for everyone and deserve careful research. But the principle of a secure floor is gold. The sixth move is about staying flexible. Move 6. In down years, they spend a little less, instead of pulling more out of a falling portfolio. A rigid retiree withdraws the same fixed amount every year, even when the market is down 40%. A flexible one adjusts. In a crash year, they trim the optional spending, the big trip, the new car, and let the portfolio breathe instead of bleeding. Even small, temporary cuts in a downturn dramatically increase the odds that the money lasts for life. Then in the good years, they spend more freely. Their lifestyle flexes with the market instead of fighting it. Treating your retirement spending as adjustable, not fixed, is one of the most powerful and most ignored protections there is. The seventh move is the hardest one emotionally. Move 7. When everyone else is panicking, they do nothing. And doing nothing is the entire skill. The biggest mistake in every crash is selling in fear. The moment you sell, a temporary drop on paper becomes a permanent, real loss. Historically, every single market crash has eventually recovered and gone on to new highs. The people who got hurt were the ones who sold and never got back in. And recoveries often come in sudden bursts. Miss just a handful of the best days, usually right after a crash, and your long-term returns collapse. This is exactly why the earlier moves matter. With a cash cushion and a secure floor, they are never forced to sell, so they can simply hold and wait. Staying calm in a crash is far easier said than done. The trick is not willpower, it is having a plan in place before the fear ever hits. The eighth move turns a crash from a threat into an opportunity. Move 8. Instead of fearing a crash, the smartest retirees calmly buy into it. Rebalancing just means returning your portfolio to its target mix. When stocks crash, they become a smaller slice, so rebalancing means buying more of them. This forces you to do the hardest thing in investing, buying when everything is on sale and everyone else is terrified. To a prepared retiree, a crash is not a disaster, it is a rare discount on assets they were going to own anyway. Because it is a mechanical rule, not an emotional decision, they can act calmly while everyone else freezes. This only works if you are not relying on that money right now, which loops back to having your cash cushion and income floor in place first. Now, before you go all in on safety, there is a trap you must avoid. Here is the mistake people make after hearing all this. They panic in the other direction and move everything into cash. But a retirement can last 30 years or more, and over that time inflation quietly eats cash alive. Playing it too safe is its own slow crash. Running out of money because you were too scared to grow it is just as real a danger as a market crash. It is called longevity risk. So smart retirees balance two fears at once, the crash that could hit tomorrow, and the inflation that will definitely grind away for decades. That is why they keep a meaningful slice in growth assets even in retirement. Protection and growth are partners, not enemies. The art is not avoiding all risk, it is taking the right amount of risk in the right buckets, so you are protected now and still growing for later. Which brings me to the honest part. Let me be completely straight with you, because you deserve it. You cannot avoid every market crash. Anyone promising that is selling something. These moves do not make crashes disappear, they make them survivable. Done well, they can turn a crash from a life-altering catastrophe into a temporary bump you barely feel. That is the realistic goal. Every retiree's situation is different, your age, your savings, your health, and your income sources all change the right answer for you. And the big one, I am not a financial advisor, and this is not financial advice. It is education to help you ask better questions. Before making real moves with your retirement, please talk to a qualified, fee-only fiduciary advisor who is legally required to act in your interest. The point is not to scare you about crashes. It is to show you that with the right preparation, they lose almost all their power over your life. So let us put it all together. Here's everything smart retirees do, in one place. 1. Keep 1 to 3 years of expenses in a cash cushion so you never sell stocks in a crash. 2. Diversify so not everything falls at once. 3. Get safer as you age, taking less risk when a crash matters most. 4. Live on income instead of selling shares. 5. Build a guaranteed floor for your essentials. 6. Spend a little less in down years instead of selling more. 7. Never panic sell, because every crash in history has eventually recovered. And 8. Rebalance into the crash and treat it as a discount, not a disaster. Remember our 2 retirees? Same money, same crash, opposite endings. The one who survived was not smarter or luckier. She had simply built her money so that no single crash could ever force her hand. Cash to wait it out, income that kept paying, a floor under her essentials, and the calm to do nothing while others panicked. You do not need a fortune or a finance degree to do the same. You need a plan that assumes crashes will happen, and prepares for them in advance. And like always, none of this works without understanding the basics first, how risk, income, and inflation actually behave over a long retirement. The best time to crash-proof your retirement is long before the crash, ideally years before you even retire. So pick one move from today and put it in place this month. Future you, sitting calmly through the next crash, will thank you. If this gave you a new way to think about your money, you know what to do. Keep building, and I will see you in the next one.